Hey everyone, and welcome to another deep dive with us. This time, we're going back to 1984 to take a look at Warren Buffett's letter to Berkshire Hathaway shareholders. It was a pretty interesting time. Inflation and interest rates were all over the place. And as you'll hear, I think, Buffett had some pretty insightful ideas about how to deal with all that uncertainty, ideas that might make you think differently about your own investments, even today.
Absolutely. I think it's really striking how relevant some of these insights are even today, especially his emphasis on the importance of intrinsic business value. Berkshire Hathaway actually only saw a 13.6% growth that year, and Buffett himself called it mediocre. But, he didn't seem all that worried about it.
Yeah, that really caught my eye too. He was comparing it to their 20-year average, which was 22.1%. But it seems like he was much more focused on building strong, sustainable businesses for the long haul, rather than chasing after, those quick short-term gains.
That's a great point, and it leads us right into one of his key themes in the letter. He says he needs a few big ideas to hit a 15% annual growth over the next decade.
Okay, wait a minute. Big ideas.
Mm.
What exactly does he mean by that? Is he talking about some groundbreaking inventions or like revolutionary technologies?
Not really, no. What he's talking about is finding those companies with real earning power, companies he could acquire and add to the Berkshire Hathaway portfolio. Think of it like this: large purchases, businesses with a proven track record of success, good returns on equity, and, relatively easy to understand operations.
Got it. So
Where
basically he's looking for those hidden gems, the ones that the market might be undervaluing right now.
Exactly. You can see this reflected in some of the companies that Berkshire acquired around that time. See's Candies, for example, Nebraska Furniture Mart, the Buffalo Evening News, they all kind of fit that mold.
See's Candies is a fantastic example. They've really done an incredible job
Mm.
of maintaining their quality and that really strong brand loyalty. I remember reading somewhere that they actually refused to streamline their production process because they didn't want to compromise the quality of the chocolates.
Exactly. That's precisely the kind of long-term vision that Buffett really admires.
Yeah, and it seems so counter to what a lot of businesses are focused on today.
Right. It's that commitment to intrinsic value over short-term profits that you see throughout his approach to investing.
Now, there's another move that stood out to me. Berkshire invests in Washington Public Power Supply System bonds. Even though they had just defaulted on some other bond projects, it seemed like a pretty risky move at the time.
Yeah, that one raised some eyebrows for sure. But this is a great example of how Buffett applied a business owner mindset even to bond investments. He saw those WPPSS bonds as a business with the potential to generate significant earnings, despite the risks.
So he wasn't just looking at interest rates. He was looking at the underlying business tied to those bonds.
Precisely, like an entrepreneur evaluating a new venture.
Makes sense. That's an interesting way to think about it.
It forces you to look beyond just the numbers and really try to understand the fundamentals.
But wasn't it a gamble, though, given those recent defaults?
Well, there's always some level of risk with any investment, right? But Buffett had clearly done his homework. He calculated that his $139 million investment would earn $22.7 million after taxes. That's a 16.3% return. He even compared it to a hypothetical operating business with similar earnings, which he estimated would be valued at somewhere between $250 and $300 million.
So he saw some real upside potential there. But 1984 wasn't all sunshine and roses, was it? Didn't he express some pretty serious concerns about inflation in this letter?
Oh yeah, that's a big one. He was definitely worried about inflation and how it could impact those long-term investments, particularly bonds. He even went so far as to call the long-term outlook for the dollar dismal.
Dismal. Wow, that's a pretty strong word. What was he so pessimistic about?
He believed that the government's fiscal policies at the time were setting the stage for runaway inflation, and he was particularly concerned about the impact on bonds, which he saw as less resilient to inflation than stocks.
That makes sense. If inflation eats away at purchasing power, those fixed income investments like bonds would take a bigger hit than stocks, which have at least the potential to grow with the economy. This all makes me think about my own portfolio now. Do I have the right mix of assets to handle potential inflation down the road?
That's a great question. It's something every investor should be considering: how different asset classes perform under different economic conditions, and making sure that your portfolio is diversified enough to withstand any potential storms.
This is already so insightful, and we've only just scratched the surface of Buffett's 1984 letter. Okay, so we've talked about Buffett's views on inflation and, his approach to investing in both stocks and bonds. But there's this one thing that keeps coming back to me from this letter. It's like he's really hammering home the importance of thinking like a business owner even when you're just investing in individual stocks.
Yeah, you're right to point that out. That whole mindset is kind of woven throughout this entire letter.
So it's like, instead of getting all caught up in the, day-to-day market fluctuations and all that, I should be asking myself, okay, if I own this whole company, what would I be focusing on? What are its strengths and weaknesses? Its opportunities and risks.
That's the idea. It leads to a much more informed and hopefully rational approach to investing. Buffett really believes that a lot of investors make these costly mistakes because they're not thinking this way. They get swept up in market sentiment or, those short-term price movements, and they completely lose sight of that long-term value creation.
It's like that famous quote from him, right? The stock market is a device for transferring money from the impatient to the patient. Patience and long-term thinking seem to be kind of recurring themes here.
No doubt about it. Buffett really has this deep aversion to short-termism. Whether it's in business management or investing, he sees it as a recipe for disaster. Those companies that are always obsessing over quarterly earnings or trying to manipulate stock prices, they're ultimately sacrificing that long-term value creation.
And he's not afraid to call out that kind of bad behavior either. Remember that whole section where he's going off about green mail repurchases, calling them odious and repugnant?
Yeah, he's clearly disgusted by those kinds of practices, the ones that benefit a select few at the expense of the broader shareholder base. Ethical considerations should always be a part of our investment decisions.
And it's not just about calling out others. He's also willing to admit his own mistakes. Like when he talks about miscalculating insurance losses.
I was impressed by that too. That kind of humility and transparency is refreshing, especially in the financial world, where those big egos often get in the way. And he doesn't just gloss over those errors. He actually provides a whole table showing the corrected underwriting results.
Right. It shows that even the best investors can get things wrong sometimes. But it's how we learn from those mistakes that really matters.
Exactly. It ties back to that long-term approach, right? Not letting those short-term setbacks completely derail you.
He also points out just how difficult it is to predict future insurance losses, especially in those casualty and reinsurance lines.
It's so much easier to assess the damage from a burned building than to predict the long-term costs of, say, a retiree's work-related illness.
Right, and he uses that funny little analogy to try and explain those unpredictable costs.
Oh, yeah, the rented suit for the funeral.
That's the one.
Someone rents a suit for a funeral and then never returns it.
Leading to all those unforeseen costs.
Exactly. It's a lighthearted way to make a serious point. Unexpected costs can pop up long after you think you've closed the books on something.
Especially in the insurance business, where those unexpected costs can be huge. Makes you wonder, how can we apply that thinking to our own investments?
It's a great question. When you're looking at a potential investment, are you really considering all the potential risks, even the ones that might not be immediately obvious? Are you factoring in a margin of safety to account for those unexpected events?
That's a good point. It's about being prepared for the unexpected, right? Understanding that even the best-run companies can run into unforeseen challenges.
Right. And that brings us to another interesting point that Buffett brings up. He's talking about some of those less savory practices that were going on in the insurance industry at the time, particularly among those companies struggling to stay afloat. He calls them walking dead insurers. They keep writing business at any price, just hoping for that lucky break to cover up all their past shortfalls.
Sounds like a recipe for disaster.
Absolutely, taking on way too much risk just to stay in the game.
It's a cautionary tale.
About the dangers of, regulatory arbitrage and the importance of strong capital reserves. Buffett really emphasizes that Berkshire's conservative approach, which is focused on financial strength and disciplined underwriting, sets them apart from those walking dead companies.
So it's about having that solid foundation and not being afraid to say no to those opportunities that don't meet your criteria.
Exactly.
It reminds me of that Business Wanted ad he included in the letter,
Right.
outlining all the specific types of companies Berkshire was looking to acquire.
It shows his commitment to transparency and open communication. He's not hiding behind any of that, corporate jargon.
And speaking of engaging with shareholders, Buffett dedicates a good chunk of this letter to explaining Berkshire's dividend policy.
Right. He argues that earnings should only be retained if they can be reinvested to create at least $1 of market value for every dollar retained. Otherwise, it should be distributed back to the shareholders.
That makes sense. It's all about making sure that capital is being allocated efficiently.
Exactly.
Right.
Whether it's through reinvestment within the business or returning it to shareholders.
But how do you actually figure out whether retained earnings are creating that $1 of market value?
It's not always easy. It requires some careful analysis and judgment. but Buffett provides a framework for thinking about it. He distinguishes between restricted and unrestricted earnings.
Okay, I'm not sure I follow. What's
Okay.
the difference?
Okay, so think of it like this. Restricted earnings are those that are needed to maintain a business's current economic position. Like a farmer who needs to save some of his harvest for next year's seeds. Unrestricted earnings, on the other hand, are those that can be retained or distributed to shareholders without harming the business's core operations.
So even if a company is reporting those big earnings, some of those earnings might be trapped within the business.
Exactly. That's why Buffett says those retained earnings should only be used if they can create at least $1 of market value for every dollar retained, otherwise give the money back to the owners. He uses this really clever analogy, a 10% bond.
Okay, I'm listening.
So imagine you own a 10% bond. Now, if interest rates rise to, say, 12%, you wouldn't reinvest your bond's interest payments at that lower 10% rate, would you?
Probably.
Right? You'd cash out and look for those higher returns somewhere else. The same logic applies to those retained earnings. If management can't find opportunities to reinvest those earnings at a rate that creates at least $1 of market value, they should give that money back to the shareholders so they can go find those higher returns.
Makes sense. It's about making sure that capital is always working hard for you, always seeking its highest and best use. But, going back to the letter, it feels like we're just scratching the surface here. We've talked about inflation, his business owner mindset, his approach to insurance, and that dividend policy. But he also mentions this group of investors. He calls them the Superinvestors of Graham-and-Doddsville.
Oh, yeah, that's a classic section. Everyone should read that.
What's that all about?
This is where Buffett takes on the efficient market hypothesis. That was a big academic theory at the time, argued that it was pretty much impossible to consistently beat the market.
So it's basically saying,
Yeah,
you don't believe everything's already priced in.
exactly. Buffett, being a staunch believer in value investing, set out to prove that this theory was flawed.
How did he do that?
He showcases this group of investors who had all achieved these extraordinary returns by following the principles of value investing, principles they learned from their mentor, Benjamin Graham.
Okay, back up for a second. Who was Benjamin Graham?
Well, he's considered the father of value investing. His book, The Intelligent Investor, is kind of a must-read for anyone serious about investing.
Okay.
His whole philosophy emphasized buying securities when they were trading at a significant discount to their intrinsic value.
Interesting.
He believed the market often mispriced assets, creating opportunities for those patient and disciplined investors to buy low and sell high.
So these super investors were basically Graham's disciples, using his principles to beat the market.
That's exactly it. He calls them the Superinvestors of Graham-and-Doddsville, and he presents their track records as evidence that it wasn't just luck that led to their success.
So he's saying skill matters.
Yes, and that their results are statistically significant enough to refute the claims of those efficient market hypothesis proponents.
Sounds like he's assembled a dream team of value investors here. I'm intrigued. Tell me more about these super investors. Who were they, and how did they apply Graham's principles? So we've been talking about these super investors of Graham-and-Doddsville who consistently beat the market by applying the principles of value investing. Tell me more about them. Who were they, and what made them so special?
What's fascinating is their diversity. You have Walter Schloss, who barely finished college and ran his investment partnership from a tiny office with no staff.
Really?
Yep. Then there's Tom Knapp, who started Tweedy Brown after leaving the military.
Wow.
And of course, there's Warren Buffett himself.
It's amazing that they came from such different backgrounds, yet achieved such incredible success using the same core principles. It really challenges the notion that you need a fancy degree or a Wall Street pedigree to excel at investing.
You got it. It's about having the discipline and the right mindset, not about where you went to school or who you know. Remember, these super investors weren't obsessed with earnings reports or macroeconomic data like many other investors.
So what were they focusing on, and what kind of information were they looking for?
They were focused on understanding the businesses themselves. They were looking for companies with strong competitive advantages, solid financials, and competent management teams.
Got it.
Essentially, they were looking for good businesses at bargain prices.
That sounds a lot like what we were talking about earlier, thinking like a business owner. Instead of viewing stocks as pieces of paper to be traded, they were treating them as ownership interests in real companies.
Absolutely. And Buffett's track record is a testament to the effectiveness of this approach. He's urging us to adopt that same mindset, to think long-term and focus on the underlying value of the businesses we invest in.
So it's about looking beyond the hype and the noise and really understanding the fundamentals. But wasn't there some risk involved in this approach? Didn't Buffett acknowledge the potential downsides of concentrating investments in a few select holdings?
He did. He mentioned that diversification isn't always the best strategy, especially if you have the resources and expertise to carefully select a concentrated portfolio of high-quality businesses.
That makes sense. It's like saying, I'd rather put all my eggs in a few baskets that I've carefully inspected and trust, rather than spreading them out thinly across many baskets without knowing what's really inside.
That's a great analogy. It's about having conviction in your choices and being willing to go against the conventional wisdom of spreading your bets too thinly.
This has been an incredible deep dive. We've covered so much ground, from Buffett's investment philosophy and approach to insurance, to his thoughts on corporate governance and the economic outlook, and of course, those fascinating insights into the Superinvestors of Graham-and-Doddsville.
It's clear that this 1984 letter is packed with wisdom that's just as relevant today as it was back then.
Absolutely. But before we wrap up, I have to ask, what does all this mean for me? How can I apply these lessons from Buffett's letter to my own investment journey?
The key takeaway is the importance of developing a sound investment philosophy and sticking to it even when the market gets turbulent. Resist the temptation to chase short-term gains or get swept up in market hype.
So it's about having a plan and staying disciplined. Don't get rattled by the day-to-day fluctuations. Focus on the long game.
Exactly. Focus on understanding the businesses you invest in and be patient enough to let your investments compound over time. And who knows, maybe you'll find a few big ideas of your own along the way.
That's the exciting part, right? The possibility of discovering those hidden gems that others have overlooked.
Exactly. It's a journey of discovery. And if you're willing to put in the time and effort, you can achieve financial success.
Well said. So there you have it, folks. Our deep dive into Warren Buffett's 1984 letter to Berkshire Hathaway shareholders. It's a timeless piece of wisdom that continues to inspire and educate investors decades later. Hopefully, this deep dive has given you a new perspective on investing and provided some food for thought as you navigate your own financial journey.
And if this has sparked your curiosity, I encourage you to explore Buffett's other letters and writings. There's a wealth of knowledge to be gained from studying the mind of one of the greatest investors of all time. Remember, think like a business owner, stay focused on the long term, and never compromise your integrity.
Until next time.